Section 1. Candle Chart Applications. Properly used, candle charts not only help improve profits, but they also assist in preserving capital. They do so by helping you avoid a potential losing trade or exiting a profitable trade early. Exhibit 4.1 shows an example of the latter. The dashed lines in Exhibit 4.1 show a resistance area near 135. A tall white candle pierces this resistance in early March. For those who were already long on this index, this was a green light to remain long. But observe what unfolded the next session, the doji. This doji line hinted that the bulls had lost full control of the market. However, it does not mean that the bears have taken control. With this doji, one should consider taking profits, moving up protective sell stops, or selling calls. This is a classic example of the power of candle charting techniques. Within one session, we were able to glean the visual clue via the doji that while the market was maintaining its highs, the doji shouted that the bulls were not in complete control. So while the market looked healthy from the outside, the internals, as shown by the doji, were relaying the message that the market was not as healthy as it seemed. This market was, as the Japanese proverb states, like a leaking boat brightly painted. A key concept is that the more technical signals that emerge at the same support or resistance level, the higher the likelihood of a reversal. This convergence concept can be applied with candles and Western techniques. That is, if a candle signal confirms a Western technical signal, as the Japanese proverb says, like the right hand helping the left. The charts in Exhibit 4.2 and 4.3 are examples of the ease and power with which one can merge candle and Western charting techniques. Exhibit 4.2 shows how candles can confirm support and how we can use Western technical tools to get a price target. Exhibit 4.3 displays how a candle signal helped confirm a base. Exhibit 4.2 shows how a gravestone doji helped reinforce a resistance zone near 420. Another technical signal at or near the same price area of the gravestone doji amplifies the candle signal's significance. As mentioned in Chapter 1, a limitation of candle charts is that they normally don't provide price targets. This is why classic Western techniques, such as looking at support or resistance lines or pivot highs or lows, is so important, since you use these levels as targets. With this in mind, let's turn our attention to the same chart. Observe how this market was in a box range, discussed in Chapter 1, Section 3, of about 420 to 370. Once the gravestone doji confirmed the top end of the box range at 420, a trader could consider selling short with that signal, with a stop over the top end of the box range, with a target to the bottom end of the box range near 370. This objective was quickly met. In Exhibit 4.3, a bullish engulfing pattern that took on extra importance as a turning signal is highlighted for two reasons. The first was that the lows of that bullish engulfing pattern confirmed a potential support level set by the lows made in late January. The second consideration is that, although a classic bullish engulfing pattern has a white candle wrapping around a prior black candle, this bullish engulfing pattern had a white candle that engulfed the three prior small real bodies, one of which was a doji. Though this aspect doesn't forecast that the market will move much higher than it would with a regular bullish engulfing pattern, remember, candles don't give targets, it does greatly improve the chances of a turn and thus makes a buy more attractive. In the Exhibits 4.2 and 4.3, I touched upon combining candle charting tools with Western technical analysis. Please note that this book only touched the tip of the iceberg with this concept. Please see conclusion for more source material on ways to combine moving averages, volume, Bollinger Bands, etc. with candle charts. Candle signals converge, just as Western technical indicators do. This means that if you see more than one candlestick signal confirming support or resistance set by another candle pattern, such as a hammer confirming a support area set by a bullish engulfing pattern, the likelihood of a turn increases. Exhibit 4.4 illustrates what I call a confluence of candles. This chart also shows that candle charting techniques are easily applicable to intraday charts. Exhibit 4.4 shows a bearish falling window, or resistance zone, from $39.80 to $40.20. Thus, one could consider selling on a move up to that window.